Welcome back to Pathfinders, a podcast series from RBC Capital Markets, where we explore the fast-moving world of biotech and pharma.
I'm Darren Campili, Global Head of Healthcare Investment Banking, and your host for today's episode. We're recording live from RBC's Global Healthcare Conference in New York, where companies, investors, and industry leaders gathered to discuss the forces shaping the healthcare sector. Today, we're going to dig into what's moving markets and deals in the healthcare space right now. To help me with that, I'm joined with three of my colleagues who specialize in the sector and bring perspectives across M&A and capital raising. David Levin, co-head of U.S. M&A, Ahmed, Attia, managing director and head of healthcare M&A, and Jason Levitz, our head of healthcare equity capital markets. Gentlemen, great to have you here. David, can you tell us about the healthcare M&A market?
The life sciences M&A market has been incredibly strong. When you think about what's behind that, it's not like the broader M&A market where we've seen less transactions and larger deals. We don't have a mega deal that's been happening. These have all been deals sort of in the 10 billion size range, but it's a significant number of them that's been driving it. And if you look over the last 4 quarters, so we call it second half of 25, first half of 26, $33 billion deals plus in life sciences. If you look at the 4 quarters prior to that, there were 11. So triple the number of billion-dollar deals in this time period. And it's really been a very good mix of buyers. So you have your large cap folks who continue to be active. They've got cliffs that they're facing in some cases, and other cases they're just looking to continue to build a pipeline for the future. But whether that's Lilly, Novartis, Merck, big biotech like Gilead and Biogen, you've seen activity from all those folks, and that's a crew you would generally expect to see activity from. But beyond that, we've seen a significant amount of activity from the mid-cap folks as well. And we've seen some, not just on biotech, but on the pharma side also, with Sun buying Organon, one of the bigger deals that we've had this year. And then the other piece of activity, which is interesting, has been from sponsors. So we saw the Ahmed Esperion deal. And I would say sponsor activity, we think, could pick up in the pharma space. As we've been continuing to have our dialogues with clients, more and more sponsors are interested in thinking about pharma. So that's been great to see. There's been a lot of noise, obviously, around the FDA and regulatory questions and where are things headed. It seems that the consolidators have really been able to put that aside and move forward despite all of that noise. They haven't been shied off from that, so they've been willing to move forward regardless. And then another feature that we've noticed is the premiums, which for biotech had been historically triple digits or high double digits in a lot of situations. The last year and a half, we've seen a lot more low double-digit premiums. Doesn't mean there's not triple-digit premiums and high premiums still taking place, but it's been more of a mix, which I think actually helps fuel more deal activity. You've got more flexibility to enable deals to get done. CVR is also a feature, and I'd say over the last 18 months, perhaps a little bit more heavy as a way to bridge gaps. So that's all been positive from an M&A perspective. And then the last piece I'll mention is if you had looked back over the last 5-6 years, a lot of the deals prior to, I'd say, the last 18 months or so were single buyer situations. And what we've seen over the last year is a number of competitive situations and publicly competitive situations. But just as you look at the backgrounds for what's happened with those deals, people were bidding up to the finish line to help drive value as well. So interesting to see that more competitive dynamic take place from an M&A perspective as well. So overall, it's been a very robust life sciences M&A market, both on the public side and the private side. And we don't really see that changing. That ought to continue to drive through the rest of the year.
Ahmed, so you spend most of your time in healthcare services and medtech tools and diagnostics. What can you tell us about what's going on there?
As you think about the drivers and pillars of M&A broadly, which is relevant for both services and medtech, you still have a lot of companies that want to build scale to be competitive, just given the macro environment, number one. You see other companies that definitely want to fill portfolio gaps, especially to differentiate relative to the immense amount of competition in the space. There's another theme broadly around technology and the convergence, whether it's with AI with respect to medtech services, tech-enabled businesses, payers, providers. So we're seeing the healthcare IT dimension actually permeate all the sectors that you mentioned earlier, which is driving activity. The one pillar that, unlike 5 years ago, is not necessarily driving volume is the theme of geographic expansion. And as a function of some macro political noise, there's a lot less of focus on the geographic expansion piece in particular. And how we're seeing these pillars manifest themselves in services and MEC is really a couple different flavors. One is when you think about the take private activity, so LBOs by financial sponsors. When you looked at volume in 2024, the take private activity was around 25 billion. In 2025, we had about $50 billion, so approximately double the amount of activity in take privates. And again, that's largely healthcare services as well as medtech. But we saw, again, the whole Logic transaction with Blackstone and TPG as one, a variety of other deals that are very sizable and big in scale. The take private activity, we expect it to increase. And we've seen that as a function of the dislocation in terms of public company share prices in healthcare IT, pharma services, traditional services. We expect that trend to continue. The other piece we've seen is we've seen a ton of carve-out activity. Carve-out volume in 2024 was about $40 billion of trades, again, largely outside of life sciences. And when you look at that volume in 2025, that jumped to 75 billion. So another theme where, again, you almost doubled the volume as a function of public company strategics, really thinking about what's core to them and what's not. And we've seen a whole bunch of very sizable carve-out deals, unlike those that we've seen in the past where it tended to be smaller. But again, companies are really thinking about what drives valuation. Top line growth is still key from a market perspective, but you've got to marry that with bottom line profitability. So there's very big strategic decisions that, again, are driving carve-out volume by the sponsor community. The financial sponsors in services and medtech in particular have done a great job in terms of the very large cap sponsors raising 20, 25, $30 billion funds. The capital obviously has to get deployed in good businesses. And I would also say what's also driving the activities, we're seeing convergence and resurgence, if you will, of some of the big cap strategics that, as a function of regulatory noise in the past, as a function of fear of creating dislocation in the market, do very sizable deals. What I think is really critical is that there's very specific pockets within each subsector that are really driving a lot of that activity. So for example, in services broadly, you see a very significant amount of deals in the revenue cycle management space, which is a pocket of healthcare IT. It's an area where the returns have been really robust for the strategics and the sponsor community. There's a lot of tech disruption, innovation, et cetera, that's driving some of this M&A. And that is a sector, for example, that we expect to see active and remain active going forward. So overall, feel very good about the volume of activity we're seeing, feel really good about the pipeline in terms of what our firm is generating and some of the situations we're working on. But more broadly, some of the buy side and sell side opportunities that we know will be in market through the balance this year.
Thank you, Ahmed. So a lot of your business is financial sponsor oriented. How are the financing markets impacting that?
Yeah, the financing markets have absolutely been volatile over time, but by and large, very active and very robust. You have it both from the banking institution side as well as the direct lender community. There's been situations of late where we've seen direct lenders be very aggressive and put leverage on really strong businesses up to 7 times, which again, in the macro market and the volatility was surprising to us. The assets that are being pursued, it's really been a tale of two cities. You've got very well-established businesses that are humming, that have a clear moat, that have a financial profile that's compelling. Those businesses, you have a ton of financing sources chase those opportunities because their capital also has to get deployed. But we're also seeing in this market, as the macro volatility kind of continues, there are businesses fundamentally that struggle from a profitability standpoint. Maybe growth is muted for a reason or two as a function of some of the geopolitical global dynamics that we're experiencing. Those situations end up being challenging. But what we're finding in 80 to 90% of the deals that we're working on, you're able to find a solution on the financing side. Yes, it may be a little bit more expensive, but we're not seeing the financing markets be a material challenge to the M&A environment, and obviously expect as the economy progresses that the sentiment will get better and we'll be able to finance deals more easily going forward.
There's been a lot of headlines about direct lenders and some of the issues that they're experiencing? Are you still seeing them be competitive with the banks in terms of providing capital for these LBOs?
Yes, we're reading a lot about the macro noise and the challenges that some of these banks are facing. I would say it's very acute to the software market as a function of the phenomenon around AI. But as we think about traditional services, as we think about classic payer provider businesses, as we think about healthcare IT that's not necessarily software oriented, we've actually seen a very constructive market, which is very different from the macro headlines that you're seeing in the paper every other day.
Ahmed, last question. There's a lot of healthcare companies sitting in private equity portfolios, and some of them are perhaps past their due date, meaning a lot of that I think is in the provider space, but perhaps you can shed some light on that. What's your expectation for those portfolio companies? Do they get put into continuation vehicles? Do they get sold? Are there buyers for these assets?
Very interesting dynamics to your point about the number of portfolio companies that have exceeded the 5-6 year investment horizon. We're tracking many of those because we do expect there'll be monetization events. And I would say continuation vehicles were in vogue through 24, through the end of 25. But ultimately, the sponsor owners of those assets want home runs. They want to capitalize. They want to monetize. They're getting a lot of pressure from their LPs to exit those investments and really focus on new emerging growth sectors. So what we're seeing on the ground is the pipeline of the businesses that have been in sponsor portfolios for more than 5 years. I could tell you there's a lot of those situations where there are banks engaged, ourselves included, prepping for the perfect point in the market to launch if some of the macro trends improve. So we expect that'll be actually a huge catalyst, which is a very significant piece as to why we're pretty bullish about the volume of activity, because the assets have to get sold. And the other dynamic that's going to drive some of this volume is that sponsors always want to find differentiated angles to prevail. And what we expect to see is a lot of sponsor to sponsor bespoke negotiated situations that will help one sponsor monetize and at the same time help another deploy capital in a very material way. And that trend in and of itself, we expect will drive some of the volume going forward.
And do you expect the sellers there to roll equity in those transactions?
Absolutely. And the reason for that is it's become a lot harder to find very high quality scaled assets that are sizable. And as a result, existing owners of some of these businesses want a piece of the upside. And so whether they roll 5%, 10%, 20%, it's going to be situation specific. But again, you can get really good marks on the assets that you have, again, assuming they're good quality, and ensure that you're getting incremental upside in partnership with the next owner, and expect that's going to be a huge trend going forward.
Jason, can we talk a little bit about the equity markets?
Zooming out, thinking about healthcare in the broader context of the U.S. equity markets, healthcare weighting in the S&P 500 is roughly 8.5%, which is at a multi-year low and several hundred basis points below the historical average. So on one hand, you've got a sector that is facing challenging performance across a number of vectors, particularly among large cap medical technology and services companies. But the flip side is the financing markets have been incredibly robust. And in particular, in the life sciences and biotech area, we've seen really record levels of activity based on a handful of metrics. But it's been an interesting market from that standpoint. And as a consequence, investor outcomes have varied quite a bit. So many of the large, long-only diversified healthcare funds are down on the year. But again, those investors that have been indexed to life sciences and biotech in many cases have done extremely well for some of the reasons that David talked about earlier, in particular around the robust M&A calendar and the ability to recycle capital, one. And two, there have been a number across the year of very positive clinical catalysts and drug launches that have driven strong performance in the sector and for investors. So while, again, I mentioned the diversified folks in some cases are down, call it 5% on the year, some of the better performing sector dedicated funds are up, and this is through end of April, circa 10 to 15% on the year, so outperforming the broader market. So the range of outcomes for investors has varied quite a bit based on where they focus. But again, there are pockets of strength, and financing markets have been incredibly robust.
Can you talk a little bit more about the IPO market?
So that's one of the areas where we've seen a nice rebound after some disappointing years prior. We're not back to the levels we saw in 20 and 21, and I'll focus first on life sciences and biotech. That's where the bolus of activity typically comes. We've seen 11 IPOs year to date, I think raising roughly $3.5 billion, including the largest biotech IPO in history. So seeing large transactions. Performance has been mixed, but there have been some very successful transactions. The more successful deals, at least year to date on the IPO side, have been, I would characterize as lower from a clinical risk standpoint. I would say that more broadly, zooming out a little bit, investors and deal flow has tended to center around, not surprisingly, oncology, I&I, and CNS have probably been broadly across financing markets the most active sectors. And when we step away from life sciences, we haven't seen as much activity across other segments of healthcare in the IPO market as, frankly, we would have hoped year to date. We did see a large private equity-backed emergency medical services business IPO. We've seen a couple of med tech and tools and diagnostics transactions. We haven't really seen much activity on the healthcare technology front. I think that's one area where we could see more activity toward the end of the year and into 2027. I would say that the private equity backlog, it doesn't seem to be a big census of companies that will likely come this year, but I do feel like that shadow backlog is building. And maybe just to circle back and close the loop on biotech, we do expect the run rate to continue. And the other piece around the IPO market, which I think is particularly interesting, is this notion of companies, instead of an IPO, but from a position of strength, so well-funded companies backed by strong science and quality private investors, choosing to find reverse merger partners and raise substantial amounts of capital in the form of a PIPE transaction along with a completed reverse merger to get public through a different vector, but equally successful. And in some cases, those transactions we're finding good investor interest in, multi-$100 million PIPE financings alongside these reverse mergers. So a lot of optionality for companies in life sciences. Again, I would say outside of biotech, it's been a little trickier and fewer transactions and probably a lighter expected pipeline in the second half.
Historically, reverse mergers were considered not as interesting. Why has that changed?
I think what's changed is a couple things. One is there are a lot of public shells now that had really strong investor backing and raised large quantums of capital in the 2021 IPO cohort. And a lot of those companies still have really strong boards of directors. They still have some residual capital. And because they'd only been public for a couple of years, they have relatively clean shells. So the mechanics around the combination are cleaner. Again, the other vector I think that's critically important is the availability of capital through the PIPE. Because what that offers, and again, the older version and vintage of reverse mergers I think you were referring to, were often completed without a large financing alongside. And because of that, those companies often weren't well positioned in the public market with sell side following, research coverage, and enough capital to actually execute on the new pipeline for the combined company.
To some degree, the rising tide raises all ships. And one dynamic we're seeing is the pursuit of dual track processes where shareholders, whether they be sponsors in particular, as they think about monetizing assets, they're considering both pathways. Should I sell? Should I take the company public? Obviously, implications in terms of how quickly you can monetize. But as the equity capital markets are improving, there is that dimension and there is that competitive tension you can create on M&A as a function of equity capital markets. So that in some respect drives activity. Conversely, as share prices rebound, the quantum of take privates probably decline and the quantum of carve outs in the same vein probably get hampered because again, as bigger corporates continue to be rewarded by the broader markets, they really have to reassess whether or not it's worth the time, energy, and effort to maybe carve out what may be deemed non-core if they're getting value uplift from the overall financial profile.
We've seen more 500 million plus transactions in equity capital raises by public biotech companies this year than in the prior 3 years combined, and we're only in May. So it gives you a sense of the quantum of capital available to, call it the winners in the sector. And most, if not all of those companies, or at least most, were actually still clinical stage companies raising kind of that quantum of capital. And I think the other really interesting vector that companies are evaluating, and we've seen a big pickup in activity, is convertible debt. And the equity-linked product historically has been used only selectively by life sciences companies. And that market is performing really well as an asset class, and there's been a tremendous amount of investor interest. A lot of it's been on the technology side in AI and crypto, but it's translating as well to biotech because they, in some cases, have similar trading profile in terms of liquidity and single stock volatility. In a lot of respects, notwithstanding some of the volatility around performance, it's been a pretty good time for companies to raise capital.
Jason, how would you contrast the biotech financing market of 2021 to today, recognizing that they're quite different from a quantum perspective?
I think there's more selectivity on the investor side around the kinds of companies that they want to see go public. I mentioned earlier, companies with de-risked clinical pipelines to a greater degree, those going after big markets in TAs that are well understood and have big opportunities. So I do feel like the quality bar is higher. It's incumbent on us as underwriters and partners to make sure that we can raise capital for the right companies that can be successful in the public markets this year.
And is that why we have these reverse merger candidates, because of all the companies that went public in 20 and 21?
Yes, exactly.
And some of those companies were earlier stage.
Many of those companies
more
were
platform oriented.
More platform, some even preclinical companies, but certainly early clinical and platform companies were far more common than we see today in the current crop of IPOs.
David, can we come back to big cap pharma? And where are the big cap pharma companies going? We've got obesity. All I hear about is obesity, obesity, obesity. There are two primary players right now, but then there are others that are rumored to be interested or actually getting into the space. What does that mean? What's the implication for where they go in the future?
Look, obviously, everybody thinks about Lilly and Novo, but there are other players that are in the obesity space from a big cap perspective. And obviously, it's been game-changing to see these therapies come through. The market opportunity is huge. And so obesity and cardiometabolic overall, I think, is seen, not surprisingly, a new resurgence of interest and focus. But it's certainly, the activity's not been limited to that, right? I mean, we've seen activity in CNS, in oncology, immunology. Obviously, is continue to be super strong. We've seen a bunch of in vivo CAR T deals where people have spent significant amounts. So I think it's reasonably broad based at the moment. People are looking for opportunities, as always, driven by where the science comes from and where significant commercial opportunities can exist. The other piece I want to circle back to in terms of areas of focus, the rare disease area in particular has become a significant area of interest for the mid caps in particular. So as you think about the pharma companies that are looking to reinvent their stories from a commercial pharma opportunity perspective, where they can have more specialized sales forces and products that are more insulated from competition.
And this is a question for everybody. How does the administration impact deal activity in healthcare?
I think it's in pockets. So when you think about Liberation Day from last year, as you think about pharma manufacturing businesses in particular, and the idea of having onshore capabilities, we've seen that drive deals in terms of OUS buyers in Europe and even Asia trying to find capabilities within the US. So I think that's kind of a net positive in terms of inflow into the US market in particular. That's one dimension. The other dimension that has a little bit of a regulatory flavor is you think about traditional healthcare services business, whether it's health plans, whether it's home health companies, whether it's businesses that are focused on either Medicare Advantage or Medicaid or what have you. There's always the stroke of the pen risk that's always existed over the last 20, 30 years. But with some of the developments in the political arena around reimbursement in particular, That has definitely had an impact on some of the companies that focus on those because of the difficulty and challenge for both strategic and sponsor buyers to underwrite some of the risk. But what we're seeing, as long as potential parties have the ability to guardrail what some of the negative consequences may be in terms of, again, regulatory changes, we're still seeing transactions get to a conclusion. But it definitely has had a negative impact on selective situations over the course of the last year.
David and Jason, comments?
I think that overall, from a biopharma perspective, the consolidators seem to have looked through a lot of the noise. And so we're seeing this robust activity in spite of it. I do think there was a bit of a pause around Liberation Day last year, but I don't think it lasted very long. And things picked up shortly thereafter, and we started seeing significant announcements hitting in August, right? So that means that those conversations had started earlier in the summer. So maybe you had a couple of months where people were getting their head around things, but then after that, it seemed to move on. I think the other issue, though, that had caught people's attention last year in particular, but I think is still a little bit of an overhang from a regional perspective, is the whole MFN pricing discussion. And I think there was a lot of focus on it last year. I think as things evolved and you started to see some announcements take place in terms of companies working with the administration to address MFN concerns or pricing concerns, that much of that concern dissipated. But I do think there's still an uncertainty that's out there on how do you think about managing drugs if you've got different prices in Europe, for example, than in the US, and in certain markets where it may be more challenging to commercialize, or if it's really very strongly going to be a US product versus a European product, do you want to take the risk of potentially having different pricing in those areas? So it's probably had some chilling effect on European regional rights deals, I think, as some companies have been less comfortable, less certain. What does that look like? What is the potential impact for them there? I don't think that there's no activity there. I think that activity's continued. We've seen some recent activity just this week on that topic, but probably has been some chilling effect around the uncertainty of MFN out there.
Jason, any impact from a financing perspective?
I'd say the wildly oversimplified answer is uncertainty is bad for financing markets. Leadership and operational activity at the FDA is probably what's most acutely important to potential buyers of deals coming from clinical stage biotech companies, which is a lot of what we're underwriting. The perception that it's close to or business as usual is probably most important. And again, if uncertainty advances to a degree around that process where it's an overhang around clinical development, then I think it could have a meaningful impact on financing markets. But I think in general, David, I characterized it well. You're able to kind of work through the noise. And as long as it's not seen as existential, I think financing markets will continue apace. Other issues will probably have a bigger impact than regulatory in the short term if we see a kind of surprise geopolitically or from a macroeconomic standpoint.
One last question. How is AI impacting either your day-to-day or your client's business? And we can do it like very top line, quickly around the table.
From an operating perspective, it's been incredibly valuable to just help us get smarter and more efficient around operating our business. Obviously, a much broader question related to the sector, and I'll defer to my M&A partners more broadly, but I would say certainly on the generative side, from a drug development standpoint, there's a tremendous amount of interest in leveraging AI to build molecules that are better on target, fewer off-target effects and side effects. There was a $2 billion plus private financing in the last week, as I'm sure people are aware. So a tremendous amount of capital chasing AI in all areas, clinical trial development, management, all across sort of pharma and pharma services and biotech. And then a query on the predictive side over time, will companies be able to use AI to better assess the probability of success around drug development? So obviously all these these variables are in very early stage, so it's really hard to quantify the impact, but it's absolutely part of the conversation across verticals with every client we talk to.
Ahmed, anything to add?
The AI topic is at the board level on a daily basis, existential to some degree, but in a positive way in terms of how do companies think about their differentiation, their moat, and what we're engaging in conversations on. How do you leverage all the innovation and technology to be highly relevant, strategic, and deliver value to shareholders over the next 10, 20 years? And as we think more acutely about very particular deals across different sectors, the conversation really is one that has a little bit of two flavors. One is, as you have bigger scaled companies, do they have a right to win in terms of leveraging AI capabilities, buying emerging companies that have impact, and really turbocharging their respective business relative to their competition and their peers? Or will the emerging companies that may not necessarily have the scale or the platform overnight kind of rise to a huge amount of success? And what we're seeing in the conversations we're having at the board level with the C-suite is that those of scale believe they've got the competitive advantage in leveraging AI, acquiring differentiated AI companies to really drive profitability, but more importantly, drive competitive differentiation down the line. So by and large, seen as a positive as, again, technology continues to evolve.
Great. I think that's a great place to end. Thank you for a great discussion today, and we look forward to coming back on the podcast again soon to share more insights on the healthcare sector.
Thanks for listening to Pathfinders in Biopharma, brought to you by RBC Capital Markets. Please remember to subscribe to get more great content and be alerted about future episodes. This episode was recorded on May 20th, 2026. If you'd like to learn more or continue the conversation, please contact your RBC representative or visit rbccm.com/biopharma. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.